Welcome to today's webinar on construction conditions. I'm Haley Shenander of the Federal Reserve Bank of Minneapolis. Before I turn it over to our speaker today, I have a few housekeeping items. Slides for this presentation and a copy of the video link will be emailed to all registered attendees next week. Ron will be entertaining questions at the end of his presentation, so if you have a question, please type it in the chat box on Zoom. We'd love to get your feedback at the end of this presentation as well, so please take a moment to fill out the brief 3-question survey that pops up in your Zoom window when you exit the webinar. And with that, I'll turn it over to Ron.
Thank you, Haley, and good morning, everyone. Appreciate everyone's attendance today. We had, I think, near 400 people register, and hopefully we'll get at least half of those showing up today. And for those that are wondering, we always share our slide decks with everyone. So even if you can't attend, say, a future webinar that we do, always sign up because we're going to send you the information regardless, and you can consume it at your leisure. So before I get started, I need to share my disclaimer. The views that I express here are mine and not necessarily those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. So one of the things that I'd really like to do first is to thank partners. So we do a lot of survey work at the Minneapolis Fed, and we do a lot of it through partners, a lot of industry associations that get our surveys out to members. In this case, the construction survey is the largest construction-focused survey among the 12 Federal Reserve District banks. We're very, very proud of that, and we really couldn't happen without our partners. So thank you to any of the partners that are listening. Thank you to members that are members of those organizations that have participated in the survey itself, and hopefully here to get some of the information that you provided to us. It really is important not only for the Minneapolis Fed to have a better understanding of what's happening in the construction sector, but we share that information with our partners. They give it to their members, and we also share it with the public. So we all have a little bit better idea of how this important sector is doing. If there happen to be any other trade groups that are listening right now, or you happen to know of other trade groups that might be interested, please reach out and contact me. I have some information at the end. I'd love to hear from any other organizations that would be interested in participating in this. So let me give you a little bit of survey background. So this survey was conducted from October 29th to November 18th. So roughly a about 3-week period. We had 306 responses, which is almost exactly what we had in November of last year. So just a comparison, because I'm going to do a lot of comparison over time to the 2023 survey. So to give you a little bit of idea how the composition of our responses is that from a firm size, that's the chart on the very bottom left. There's generally pretty similar response among firms of different size. If you go over to the top right, we did have more non-residential and commercial respondents in this survey. Now you could check any area of any subsector that you had substantial work, so that's kind of a judgment thing. And we had a lot of respondents that worked at least partially in that sector. And we also had fewer residential than the previous, but at almost 40%, that's still a very good sample in that area. And then in terms of geography, so we do have organizations from all 6 district states that participate. Our response levels are very different, and the responses in this case are very overweighted in St. Paul and Minneapolis and St. Paul and Greater Minnesota. So I think the best way to describe it is this is a very good characterization of what's happening in Minneapolis and Minnesota in general. I think some of these things probably relate very well outside of Minnesota as well, but we don't have the responses to say that this is a good reflection of activity outside of Minnesota. Okay. I also need to remind you that because of the convenient sample that we do, the results here are a snapshot. We think they're very good directional. They offer very good directional sense of where the industry is going, but it's not a very specific picture of where things are at. So it's not a scientific sample. So please interpret all of these results very carefully. Okay, so some takeaways. The best news I can share with you is that a number of the last surveys have been really fairly dour. And what I would say now is that we have very clear improvement in the survey results. I wouldn't say that things are to the point where we can say things are good across the sector, but they are better. In terms of revenue and profit trends, infrastructure and industrial are doing much better than the other two, residential and commercial, but even there we're seeing some improvement. We are still seeing some mixed signals, though. projects out for bid are still contracting. We're not seeing a lot of growth in that area, and backlogs are also shrinking. But we are still seeing very solid labor demand, and labor availability is also better, which is great for employers. We are still seeing that inflation is a concern, but it is moderating. I'll give you some evidence of that later. And the same with wage growth. It's flattening overall, but it's still comparatively high. And the outlook, I think more optimistic than I was probably expecting, and certainly the most optimistic we've seen in a couple of years. So let's get into some of the details. So before I start with anything, for those that are new, how I often do this is I do a comparison, because we'll often ask several questions in the same question, and I'll do this bar structure to kind of give a temperature gauge. So green means good or growth, red typically means bad or decline. And our first question we always ask is what's happening to recent revenue trends, as well as what are your future revenue expectations. And here, the good news is that it's actually slightly net positive. So in other words, we're seeing more firms respond that revenues grew over the last period compared to last year, compared with those that saw a decrease. So that's the very top bar. So a little bit slightly net positive. And then in terms of the outlook, slightly better in terms of fewer firms are saying that revenues, they expect them to decline. So again, I wouldn't call this an aggressively positive, but it's better than it was previously. And let me show you how. So here we have the last 4 November surveys. And I have the dates off on the left and then November being at the bottom. And what you'll see here is we saw the general deterioration from November 2021 through last year's survey in terms of what our revenue trends were. Okay. And the most recent one, even though it's only slightly net positive, it is a significant improvement over last year's survey. And again, I like to compare year over year because construction is a very seasonal industry. And so I think that year over year comparison is the right one. The other thing that you should note, though, is because it's a year over year comparison, and because last year and the year before we've seen some contraction, that also kind of lowers the bar in terms of the comparison. So kind of trying to triangulate exactly where things are, I would say things are not necessarily great, but they're improving. In terms of future revenue expectations, really exactly the same story. We're seeing more positive outlook in general about where people are expecting revenue growth. Company profits too. This one is still a little bit more net negative, or a little bit more net neutral, I should say. But again, you can see here that we have a very positive trend overall. So the top chart is comparing recent profits, and right now it's at about net neutral. So about the same number of firms are seeing growth as they are decline. The good news there, if you look at the bottom chart, is that both charts, excuse me. The recent profits is improving over time, and in terms of profits, we're seeing even a little bit better improvement there over time. Still net negative, so not great for everyone for sure, but we're seeing improvement. So in terms of some sector breakdown, we ask firms to tell us what areas do you see the most of your work in. And we have 4 categories there on the left: infrastructure heavy, industrial, residential, non-commercial, or non-residential commercial. And what we're seeing in terms of sectoral performance is that infrastructure and industrial really are seeing the best activity. That's been pretty consistent really over the last several years. Residential and commercial are treading water right now in terms of what their snapshot response was right now. Really about the same number of firms seeing growth as decline. This is actually an improvement again over the last survey. In terms of the outlook, that's the bottom chart. I would say it's fairly similar in terms of industrial and infrastructure doing the best, but there's a little bit of compression. Commercial and residential both seeing a little bit better performance there compared to the other sectors. One of the things I also like to do, because surveys are really hard to really figure in terms of really trying to put a hard assessment on where things are, because there's a lot of judgment involved here. So I always like to try to triangulate what's going on with other data that I do get. And generally speaking, what I see in most of the data is that there seems to be some support for this kind of little bit of improvement in the sector overall. We're not seeing huge improvements. So if this is data from Dodge Data and Analytics, and this is the value of construction starts, and I apologize, actually, this is, oh yeah, this is for Minnesota only. The district-wide picture is fairly similar to this, but in terms of overall activity right now, you're seeing that because it's very seasonal, you're seeing the peaks and the troughs be fairly similar to a little bit of improvement over the last 2 years. So September, October 2024 actually saw a fairly small gain compared to last year. And if you look at here, non-residential is really the thing that's pulling this sector right now. And I think that's really largely due to a lot of data centers either being proposed or getting off the ground right now. I did a quick Google search in the news, and literally in 5 minutes, I came across those seven that are in some stage of work right now. So we know that's a really hot sector right now, and I think that's really been improving the sector overall. One contact actually said in the survey that, I think there's a little bit of feast or famine in this sector too, that if you happen to be in this sector and you're getting some of that work, things are good. If you happen to not be in that sector, things are less good. And that some firms are struggling outside of this sector. Also pay a lot of attention to housing permit data. And here I think there's some good news, less good news. In terms of single family permits, from 2021 to 2023, we're seeing fairly consistent decline. Okay. And then if you go to the second chart from the left, that's the year to date through October for single family. And what we're seeing is that right now we are seeing growth this year compared to last year by this point in the year. And so we do think we'll see some annual growth overall. And that's kind of reflected in some of the survey data that we have. Now, if you go over to multifamily, there's a less good story there, and where it really didn't start declining until 2023. And then if you go to the chart on the very right, what we're seeing is that there's further decline in that sector. And unfortunately, given that there's a longer pipeline to development for these particular units, I think that's also one of the reasons why some non-residential commercial contractors are seeing that there's some slowness in this space. In terms of some other activity metrics, as I mentioned when I started, the project backlog compared to last year really hasn't changed that much. Especially if you compare to November 2022, it still looks like it's contracting. Admittedly, we don't have a good sense for whether there's any negativity bias creeping in here, because even November 2022 things were really quite strong. Maybe that's when we started to see the backlog contract. But it has improved marginally over last year, and it actually improved a little bit from the residential and commercial standpoint as well. But I would not call this a positive overall signal. In terms of breaking it down, private versus public projects, this has also remained fairly steady in that private projects has been, what we're hearing is that's contracting a little bit more. We're seeing fewer of those projects compared to what we were seeing. Again, I'll just mention that the year-over-year comparisons also kind of lower the bar. So I would say this is one that we're still paying a little attention, good attention to. We're seeing improvement here at the top, with the top chart. But I would also say, because we're seeing a lower bar in terms of comparisons, it's maybe not as positive as maybe we would hope. I think the other thing to pay attention to is that firms are also reporting that they're seeing a lot of increased increased competition in the bidding process. Not surprising that if we're seeing a little bit of a shrinking, contracting pipeline, that firms are going to be going outside maybe their normal area to try to find work to keep people busy. In terms of challenges, these are not a surprise to anybody, and these have been with us really for the duration of the pandemic, but they are changing. So we ask respondents to pick two different challenges, two greatest challenges to their current operating capacity and productivity. And the thing that I take away from this is that the biggest challenge seems to be flattening out. If you look at the three to the right, labor availability, material input or inflation, and higher interest rates, all of those have seen some decline. Labor availability a little bit less. but I'll actually present a chart later here that suggests maybe this is even better than this shows. But inflation also, the concerns are less. I'll show a little bit of something on that as well. Higher interest rates, the concern there really has gone down, probably in part because the Fed has lowered rates a couple of times. And then the ones that are still going up, wage pressure saw the biggest uptick. So what we're seeing is kind of the middle factors are seeing some increase. So I don't want to say this is a return to normal because there's still some real challenges here, but things seem to be flattening out a little bit. In terms of inflation, we've seen this very persistently in that we know that that people are still really feeling inflation because even small increases on top of large increases still feel like high prices. But the annual inflation rate here does seem to be going down fairly persistently, especially at the wholesale level. Well, really, I would say at both levels over the course of the 4 years here. I would say it's a little bit more consistent on the wholesale level. We didn't see quite the same drop from this year as we did last year at the retail area. But again, prices are still moderating, which is a good signal. Labor demand is still really quite positive. Again, with construction being seasonal, this is, I would say, the part here that maybe would be concerning to some in terms of cutting employees. That's a fairly high number, but construction is also a very seasonal business. So this is very similar to what we saw last year. So I don't really see much change in that. The area that I see actually where we're seeing more change is in the middle, the hiring to replace turnover. And there you're seeing a fairly significant drop in terms of the respondents that are hiring to replace turnover. Maybe there's some attrition going on. They're letting people go, or when people leave, they're simply not replacing, or there's just less turnover. We don't know exactly which, probably a little bit of both actually. But overall, the majority are still hiring, and that's a good signal. Here's the one that I think was maybe most surprising to me, in that labor availability really has improved a lot. Now, that doesn't mean it's not a concern. Again, respondents told us that among all of the concerns, labor availability was still number one by a small margin, but it's still number one. But in terms of the degree of difficulty in terms of finding labor, we have seen really a dramatic change in terms of those that are saying it's very, very difficult. Now, I would not call this an easy labor market by a long shot. There are still roughly 40% that are saying it's very to moderately difficult. Still tight labor out there, but it is better than it was a year ago, 2 years ago, 3 years ago. It's very useful for me to, again, look at some data to see how labor availability and other measures are kind of looking like compared to actual data. And so here I have total construction employment on the left, and then the rate of change of employment growth by state on the right. And here, what I would point you to is what we're seeing is generally decent construction growth, but we're not seeing as much in terms of Minnesota. It's really the only one that has seen a little bit of a lag over the last 18 months or so from a construction standpoint. So that's an indicator that I'll also be paying some attention to going forward. Wages, we know, have been high during the pandemic. They've been high in construction really even before the pandemic. And generally speaking, we're seeing that it's kind of more of the same. There's a little bit of change, and most of the change in terms of the decline over time has come mostly at that top area. So we're not seeing quite as high or topped up wage increases, those over 5%, as we were seeing earlier. But in general, I would call this kind of pretty persistent wage pressure. And finally, what I would say is maybe even the best news, or at least the most positive news of the survey results, and that is that the outlook itself uh, really improved quite a lot. So if you look from November on the left, from November of this year to November of last year, not only did it turn positive, but it turned fairly strongly positive. And if you look, it really is kind of across the board optimism too, even though non-residential, commercial, and residential really haven't been signaling very strong growth. their optimism is not very far off of what the other sectors are doing a little bit better suggest. So there are just a few other things that that are kind of note. And here I would just ask a little bit of caution in interpreting, but these are some of the things that I found interesting too. So back in April, for those that maybe joined me then, I reported that it looked like the front end of the development tube, so architecture, engineering, they were generally a little bit more upbeat about prospects, about activity, and about outlook. Okay, and it seems to me that the same pattern is showing up in this survey. Now, we did see some improvement. I would not say it's across the board, but I do see some signs of hopefulness, anyways. That the fact that the front end might be seeing a little bit more activity, they're a little bit more positive. I don't actually know whether that's going to be the case. So again, I would ask that you be judicious in how you interpret this data, but I think it's maybe one of those signs that I'll be paying attention to going forward, just to see if this is actually optimism that kind of then flows through. Hopefully, when we survey again in April, we'll see more of this kind of filtering down to the rest of the industry. And then we also asked about interest rates. So the survey went out after obviously after the 50 basis point decline in September, but before the second rate cut, which happened on November 7th, and that was 25 basis points. And we did see a small uptick after the November 7th. Towards the latter half of the survey itself. I would not call it a dramatic improvement, but in general, what we're seeing is that there is some signs of life in terms of the effect of the interest rate cuts, but not large. And most people, the largest number of respondents were basically saying it's really too early to tell, and that makes a lot of sense. But I thought that would be interesting to share. So a quick wrap up. So overall, frankly, I'm just really pleased that there seems to be real signs that things are improving compared to last year. Again, I just want to note that the year-over-year comparisons, it's a little bit of a moving target. So while things did improve, the comparison periods also mean that we should be a little careful about signaling mission accomplished yet. In terms of revenue and profit trends, they're still not great. Roughly half and half are seeing growth versus decline, but that's better. Infrastructure and industrial are doing better, but even residential and commercial are seeing some modest improvements. Some future activities, in my opinion, giving some mixed signals. You still have requests for proposals, new projects out for bid, still shrinking, and backlogs are shrinking as well. But hiring is still healthy, and I think that's a very positive sign overall. Inflation and wage pressure is still there. I think those are definitely going to be challenges, I think, going forward, but they also are better. And the outlook very solidly optimistic right now. And we're really hopeful that, come Q1, we'll start seeing that in the data as well. And generally speaking, with this being December and heading into the holidays, want to wish everyone happy holidays, but also more importantly, good luck in 2025. This is still a very challenging environment, but we're really hopeful that the Q1 we can start to really see this sector kind of rebound and be stronger like it was a couple of years ago. Very quickly before I get to the Q&A, and if I go just a little bit long, we'll still take some questions, but I do have one request, because we still need your insights. The Fed does a lot of survey work. One of the things we are trying to do is get a little bit more regular frequency of insights from businesses. So we have this business pulse survey. Okay, and we know that people don't like surveys, but our surveys like this is designed to get information from smart people like this audience, and then to share that information with the public, with businesses, so you have a better idea on what we're seeing in the economy. So we want to get it, but we want to share it. And if anyone in the audience is interested in being a panelist to this monthly pulse survey, we actually publish a chart of our findings on the bottom left, the chart there, that's on our website. You can go see that if you need more information, but we would really like to get more panelists for this survey. The more responses we get, the more we can trust the results. So we would appreciate anybody signing up. With that, really want to say thanks to everybody that showed up. Haley, I'd love to take a few questions while we have time.
Yep. Just as a reminder to everyone in the audience, if you have questions, please type them in the Zoom chat box. So let's start with this one. Ron, what do you think is behind the optimistic outlook we saw in the survey?
Yeah, that's a really good question, and I can't say, this is opinion on my part. So take that with, for what it's worth. I think part of it is that the election is over. I think that did clear up a lot of uncertainty regarding the outcome. If I were to guess, I do think, in my interactions with this sector, I do think it's more of a Republican leaning crowd. So, the outcome itself might help some optimism there too, but I don't know that for sure. I think the other thing, and I mentioned, is that the Fed's been cutting rates, and in general, it's been communicating a more accommodative stance with regards to future rates. Now, again, things can change. If we happen to get different numbers on inflation and other things, well, we don't know exactly what the path is, but generally, the current direction of interest rates has probably got them a little bit more enthused than when rates were higher. And I still think, there are a lot of signs of resilience in the economy generally. And I think there are just certain um, circumstances that kind of seem to be pooling that maybe we're starting to see, a little bit of a turn, at least in some sectors. There are also, just to point out a couple of things like industrial spec building, multifamily, retail, new construction retail, all of those have been fairly soft over the last year or more. And so what we might be seeing is that there's really some gathering demand for some areas that maybe have been a little bit slower in the past. So I think kind of all of those factors, I think maybe swirl into a more positive outlook.
Great. And then someone else was wondering, how would you say the survey results either align or deviate from overall economic expectations for 2025?
Well, I mean, if you look at the economy in general, we saw 2.7% growth over the last 4 quarters. So I would call that, that's better than average over, say, the last 20-ish years. And in terms of construction, I think the upper Midwest has seen a little bit slower activity than, say, the southern area. Areas where it's a little bit growing more quickly. By the same token, Minnesota as a state and most of the states in the Ninth District have been performing a little bit more slowly than the U.S. as a whole. So it kind of feels like, in many ways, um, the difference between Minnesota and the US is probably the same between construction here and construction in some other areas of the country, but it sort of feels like things are improving in both cases for the region up here as well as construction. Now, again, that's with survey data that's trying to triangulate some of the existing data we have here. It's not until we actually get into Q1 and start seeing more evidence, including Friday's number with employment being announced, we'll have a little bit better idea of whether or not things are heading where they seem to be right now. And
Right.
thank you for the question.
Yeah, and it looks like we can sneak in one more question here. So someone was wondering, demand for workers is strong on the employer side. Do you know how interested workers are in entering the construction field?
I'm not the best person to speak on that. My sense is, because I've been tracking construction for a long time, I know there are a lot of efforts to start addressing the labor shortage, especially from a younger worker standpoint. I don't know exactly how well we're doing in that space. The fact that employers are having less difficulty finding workers right now, I don't expect that it's because we've all of a sudden seen many more people go into the sector. It's because things had been kind of slow. There are more people looking, and so that's probably what's helping. If things start to ramp up, then I think we'll see more emphasis and more attention onto what's our pipeline of new workers. I know there are lots of organizations, lots of our partners are working on that exactly. To the extent that they're really having success, that's not something I'd be able to speak on, though.
Great. So it looks like that's our last question for today. Thank you all so much for joining us. More information will be in the follow-up email to this event. And as a reminder, please join us for our 8th Annual Regional Economic Conditions Conference on January 15th, 2025.
Thank you very much.